Joining us now is Morgan Stanley Global Chief Economist Seth Carpenter. Seth, welcome. So, speaking of rates, we got a cut in Europe last week, cut in China earlier. We got questions about whether the Fed here might have to slow cuts. At what point does the economic reality behind some of that perhaps become not so good for global equities?
Yeah, I think it's a great question. When is good, so to speak? And I think for now, good is still quite good. The Fed is balancing lots of different things in the last data point, and part of what is getting a lot of this market discussion about skipping a cut is from the last jobs report, and that was really good. I think we have to remember, though, that part of what leaned some of the members of the FOMC to do 50 basis points was the fact that inflation had undershot their estimates. On our numbers, on our forecast, we're still going to see inflation keep coming down. And so I do think they're going to keep doing a string of 25 basis point cuts. And so what that means is as long as we're in that sweet spot where inflation is coming down, sustained growth can be good for risk assets.
But Seth, how much of a risk do you see in the market on a shift in sentiment, even if the fundamentals don't shift that much? It seems like there's been a lot of optimism in the market. The market's taken a lot of excuses to move higher and maybe shrugged off several to move lower, though maybe I'm wrong about that.
No, I mean, I think sentiment has been swinging around a lot, right? We got the big market turmoil in August when people thought maybe we were going into recession. That's clearly in the rearview mirror. But if you listen to my colleague Mike Wilson, our equity strategist, he will tell you consistently that valuations are a bit stretched. And so I think always we get these times where people take an opportunity, take a breath, and ask themselves, where are we? And sentiment, I think, can play a role in causing people to reassess things. Fundamentally, though, I do think for the real side of the economy, we're in pretty good shape right now.
Seth, I want to get your thoughts. We're 2 weeks out from this election. You had Kashkari earlier today basically saying if deficit goes to the moon, rates will be higher. Feels to me like deficit's already going to the moon. So do you want to get your outlook on that, but also what gaming out the election outcome can mean, especially when you think about things like trade or immigration or some of these areas that could have some very meaningful impacts on the economy, not only from a growth standpoint, but also from an inflation one?
No question. I do think forecasting is much harder right at the moment, precisely because of the election. You mentioned some policies. I think there are three key policy levers that matter at the macro level. You've got fiscal policy, you've got immigration policy, and then, of course, you've got trade policy. I would agree. A lot of the questions that I get from clients are about the inflationary side effects there. I think for fiscal, one of the key things we have to keep in mind is that it's not just who wins the White House. It also matters what the composition of the Congress looks like. And if we have a split Congress, which is kind of where a lot of polls are pointing, it doesn't give quite as much leeway for a big swing in fiscal policy. I think tariffs, though, are really top of mind for me, for a lot of clients. And there's likely an inflationary boost if we get all of the tariffs that have been discussed all at once. Then you could get even as much as close to 1% on inflation. However, I think the part that's underappreciated is what we saw in 2018 and into 2019 is that tariffs also produce a real hit to U.S. domestic economic activity. The manufacturing sector in particular can take it on the nose from tariffs. And I think we want to pay attention to both the inflation side of things and the growth side of things.
And as we're having this conversation, you're seeing the spread narrow for credit spreads. I mean, the gap between corporate bond yields and U.S. Treasuries, it's at its lowest in almost 20 years. Does that continue?
So we're pretty constructive in that regard as long as we continue to get this soft landing that we've been looking for. My colleagues in the credit strategy, sort of when we go back and forth around our forecasts, point out that one of the things that credit markets like the best is a lot of moderation. And so we are looking for, absent any of those big jolts from policy, we're looking for gradually slightly slower growth, the Fed continuing to lower their policy rate, but for the economy to continue to grow. And that kind of sustained moderate growth with receding inflation and falling policy rates, that really does look like the sweet spot. So even if credit spreads are a bit tight now, those tights can actually be pretty well justified.